the models work.
So unlike sectors like e-commerce, where a lot of venture capital money went into educating customers and changing their behavior, here actually you are not changing the behavior, you are actually giving something very convenient, and I don't see any lending startup complaining of lack of customers. That's one thing about this market. Hence it boils down to execution and the choice of business model rather than anything else.
So one of the things about penetration is also about the fact that India is a largely informal economy, right? The salaried class is such a thin sliver. And the transacting class is also a thin sliver, digitally transacting class. So there's no data available. So the starting point for people to figure out how do you underwrite itself is actually becoming a barrier. So from our perspective, we look at financial services from an inclusion perspective. And for us, the technology actually is in terms of extracting the data from different kinds of sources and looking at proxies for many of the things that people do instead of drawing up a balance sheet of an individual or of a small business, right? So you have to keep on substituting and creating proxies for a balance sheet because there isn't anything, and taxation is also it's such a small base. So consistently you're using alternate data really to figure out how people function and to use that as a methodology for increasing lending towards people. Now, when you do that, digitization is actually an important part of that whole, the digital tracer is an important part of the whole thing, right? So in that context, I think being a digital lender becomes a necessity as opposed to an option.
So when we look at innovation in India, what are you guys seeing in terms of new unexplored areas that fintech is exploring today, or in the next few years that hasn't come to India yet?
Well, there's one thing I could start out with. Largely even now, digital lending is for the the urban centers, if you will, or at least town centers, right? The rural economy is largely excluded in that context from the digital lending landscape as yet. We're a long way away because infrastructure is also a long way away from there. We don't have smartphones, feature phones still dominate, data usage is low, all those kind of issues exist. But that's one definitely, but that's also where the highest needs sometimes are, right? So that's one place. And also into the really small businesses, from a perspective of their working capital and how they are financing their daily lives. I think those are two areas that we.
From my perspective, lending piece has actually, it's two pieces, right? One is lending and the second part is taking the money back. I think if you look at what the government has done, I think the innovation actually has come from the government. I think if you look at Aadhaar, you look at UPI, you look at the India stack, you look at the GST platform that is being set up. I think a lot of what we're seeing here today is a function of what the government has actually done to digitize a lot of this stuff. But that's you getting a lot of good data. You're now going to get significantly more data going forward. Of course, mobility and the mobile penetration, smartphone penetration. First part of the solution is going to be solved increasingly more and it's going to become quite easier to do a lot of work around it. What is still lacking, where the real innovation has to come through, is what about the second piece, which is how do you solve for things for the money that you can't get back? What about default rates? What about recovery mechanisms? I think some of that stuff is where we find that some people are trying to figure that still out. But that's a little bit early stage. We're still people trying to figure out the lending and not the recovery.
How does that recovery process evolve from a physical to a digital process? That still needs to be figured out.
In terms of product, there are a couple of things. Again, what we've seen in more developed markets and compared to what we see in India, probably from a product perspective, you think of any type of lending product, there will be a couple of startups doing it. But in terms of number of startups, supply chain financing is an area that I haven't seen a lot of action. There are two very interesting startups, but definitely seems like a very big opportunity. And in terms of point of sale financing seems to be another area that is somewhat underpenetrated. And to your point, the infrastructure itself, when you have such low card penetration, the point of sale financing is going to be very low. But as digitization increases, we probably expect to see a lot more of that.
So, my list would include business models like B2B, which is still sort of on the fringe, not mainstream because we don't have regulations. That should come very quickly, hopefully. We're not using all kinds of data. For example, utilities data is still not available as API. Right? There's a lot of data on who's been paying electricity bills for how long, what's the size and all that. Property ownership data is not public. It's not available even as a top API or public resource. I would say we're not really using blockchain enough to pass on, to build a genuine marketplace of trading loans and assets. So there are a lot of securitization which is sort of still very manual, very process driven, and very regulated and all of that. It's not very easy. So I would like to see fungibility of assets, which is sort of very useful for the digital lenders to be able to build a book and have it off using a blockchain-based infrastructure. So I think a lot of stuff, including the infrastructure, kinds of data, and hence business model will have to come. We are a long way ahead. The good part is, I think most of participants, as an investor, I see the entrepreneurs thinking 2 steps ahead of us. Our imagination still has limitations because we always think of constraints, but the entrepreneurs, thankfully, thank God, they don't think of constraints too much. They say, what if I can do? And there's a lot more crazy ideas out there.
Let me ask a little more controversial question. We keep talking about different models in fintech, from balance sheet businesses to more asset-light lending marketplace businesses. So in your view as investors, where do you think the most significant value can be created across this value chain?
First ask whether they invested, right? And then
That start with
with that qualification.
And I was, as soon as Sid used the word controversial, Anand started to look at me and laugh because he knew he was going to ask a question on me. No, I don't think there's a one-size-fits-all. We've got businesses that we are investors in which do, which have their own book and are old-school price book businesses, which are exceptionally well-run businesses and are doing really well. We are also investors in businesses which are the other way around. I think one way to think about that is saying, in the long run, everybody is going to move towards a business that has the best economics. And we don't believe that, right? So it's a combination of what is giving you the best economics, what is available in the market, and what the DNA of the founding team is. Now, some founding teams come to us and say, hey, we are investors, we've been lenders in the past, we want to lend out of our book. We know that they'll never become an asset-light marketplace-like model, and that's totally fine. Whereas other businesses sort of start with a hybrid or start in one place and then move to more of a hybrid model or not. I think the thing that at least we try to keep in mind is saying, hey, let's keep an open mind. What might be true today may not be true tomorrow. At the end of the day, what matters is what is the best way for the business to generate economics that makes sense. For example, if day one you need to line up 4 banks to have a marketplace model, that's probably not going to happen. And so a lot of people start lending from their books. So it's a question of sort of point in time. It's hard to say what is the right thing or not. I think over time everybody will.
Well, my perspective is that typically if you want to bring down the cost of lending, the banks are the right place to go to, right? They have the least cost of funds. On the other hand, they are also constrained a lot both by regulations and their own kind of processes internally. So, and they're not going to be able to they're not taking the risk as well. So somewhere it's always becoming a balance to say, what will you prove, right? And then who takes the risk. So if you're looking at fill rates and convenience to consumers, then it becomes necessary for you to control the entire value chain. The consumer experience is basically what you're trying to do. So then you look at your own book. Once you've proven that, or you at least have a kind of a proof, then you're looking at bringing down the cost of funds, and then you take it to a bank, right? So somewhere this becomes an evolutionary process. Where it starts and where it ends is actually depends on the journey of the startup itself and the business model.
I like the inherent scalability from marketplace model, and I believe that there'll always be micro segments of having different risk profiles, each adjusting to a different class of lender. So I like the marketplace model where you can focus more on matching buyer and seller. That being said, you always have to look at it in terms of what your constraints are. If you have unlimited capital and you believe in your underwriting model, yeah, might as well take on more of the credit risk. Unfortunately, that's not the case. So you have to leverage the blended model.
I don't think that lead generation per se the easiest end of marketplace is serving any purpose in terms of disrupting the experience for the customer. It just simply passes the lead to the same whatever was going on earlier. For real disruption, the least you need is a managed marketplace like what Amazon has. They manage the entire part of the experience of the customer, and the somebody is providing the inventory, which is sort of where at that point it sort of becomes irrelevant whether it's from your book or from somebody else's book, because you actually take the call of what to do with the customer. The front end, the start
not taking the credit decision.
you have to take the right decision because that speed is measured in. That's what I'm saying. I mean, we have not, like Rohan said, we've not reached a situation where banks can match the speed and speed and precision or even the risk quality which some of my friends are doing here. They're not ready mentally or procedure-wise or just for the speed or infrastructure. So I think we need to really disrupt. It will have to be from outside. Now the raw material, which is capital or money here, could be via the banks. And I don't think the banks really care as of now. They are working with digital lending companies, either giving money to them for their books or money FLG model or just money to build their own books. Right? It's all going on. And I've seen where same bank is doing all three with the same startup. Right? That's also going on. But what is important is the entire process of the customer managed by the same entity or not. You can't do a handover and pass on the baton. That will not happen.
So let's switch gears a bit. Anuradha talked about non-traditional data. So when we look at credit underwriting, what are we really seeing on the ground as progress in terms of using non-traditional data to actually make these credit decisions? Are you actually seeing fintech businesses you've invested in evolve to that point where they're using data to make decisions? Or is it still early days in terms of collecting that data and analytics of that?
So we actually invested in one of the companies which looks at social media data, which is as far from financial data as you can go as well, right? So the way it's happened is that the way we explain it is that there are two parts to repayment. One is your intent to repay and the second is your ability, right? Ability to repay is always a financial situation. And to a large degree, you have to look at how are your expenses and your income being managed as that, and you can't get away from it. The only thing is alternate data gives you proxies which tell you that if you are spending so much, it's likely that you're earning so much. In the absence of real data and everything being in cash, that's the best that you can do. Now that actually has greater traction, right? Now on the willingness to pay as well, people have tended to use different kinds of models. Well, psychometric tests is one part of it, right? And that's been around for a while now. Using social collateral is an MFI offline kind of a situation, which you're just like transporting it into the online world as well. So all of these have real normal lending terms. It's just that because you don't have anything to fix yourself on, you're using these as proxy data, and there is enough amount of traction with people who, it takes time to build that, but there is enough amount of traction that we're beginning to see, where people have actually taken out loans which are not necessarily small in size. Right? We think that it will be only small MFI size loans, but actually there are larger loans which are going out in proxy data as well. So it's just how you kind of pitch your credit model in this context to say that this is how I'm projecting for the consumer.
Well, would you say that proxy data is a secondary step after the sort of financial data and ability to pay analysis is done?
The ability to pay is always the first step, right? But even there, you don't have a balance sheet. You don't have financial data. Bank statements are like normally salary in, salary out, right? That's all that you get out of that. So what do you do with it anyways? So you are using all kinds of expenses, data which is flowing in through your SMS, different kind of digital trails that you use, and you're using those as proxies, right? So it is always, ability to pay is actually the first step. And I think all the proxies are also pointing towards that.
So I mean, of course, it's useful in a pitch to say social data and all of that, but frankly, like I said, it's an underserved market. The banks are not giving loans enough to people having good civil scores or Equifax scores, for that matter. But and then there are so many people who are not covered by the rating agencies, although they still have a decent enough financial history. So I think it is sheer case of better penetration. We don't have to go for an overkill of doing other things. It's important, it's useful, because at some point in time, the mainstream market or people with credit rating will get saturated. It isn't saturated yet. We're finding pockets of profit, even lending to people who have good credit scores, traditional credit scores. We're finding people with good financial history, yet not having any kind of credit rating itself. And the market probably in the next 5-10 years will evolve to be things outside that, and startups will start building their social score and other alibi, non-financial data, will be able to leverage. So then they can correlate, how those things work. Right now, unlike US Western countries where the digital lending startups are lending to the bottom 20% of the population, here we are still in the top 20% of the population, probably top 10%. So most of the people, nobody is lending to the bottom half, not at all. Apart from microfinance, of course, which is completely non-technical, non-deep business. Everybody is playing the top 10-20% of the population of the country. And I think there is enough and more to do with traditional methods of evaluation. What I find interesting here is that these startups are using data, they have to, but banks don't use data. They only have thumb rules. They don't have decision-making. Mostly you see that they have thumb rules. They don't take any kind of credit risk at all. Typically, always asset backed. Either a home loan or a business loan backed by a home property is invariably asset backed. Right? So it's not necessarily a credit decision anyways. So that's
We've invested in one company in Southeast Asia that actually uses telco data for complete decisioning in markets where bureau data doesn't exist. And it actually works really well. Now that being said, I haven't seen anybody do that in India for a couple of reasons. One, you need to lose money to be able to build a model. And we are not at that place in the market yet where people have lost significant amounts of money to be able to see what's not working. It's relatively easy to get the false negative.
You need like a few hundred crore rupees of grey pool money to burn and then figure it out.
But I think that being said, I think there are relatively few people who we've seen who've also managed to have a mix of having a marketplace model, yet having data to be able to say that I'm actually not taking the risk, but I'm actually learning. I think you can either take the risk and learn, but then you lose money, or you don't take risk, in which case you don't get data, in which case you don't learn. So people need to sort of bridge that gap to be able to build long-term value.
I think if you look at what she talks about, it's ability and intent. I think across the world, if you see companies, nobody has a standard model. I mean, even in the old form of lending, you still have a human interaction to understand the intent part of the analysis, right? The ability, until now the ability was driven by, like you talked about, financial statements, perhaps of bank statements. Now those are being cut to a very small size. They're cut to a point where you can actually understand transactions second by second, microsecond by microsecond. You build that up. So I think the ability is still based on hard facts, because you have to, and then you have to supplement it with all forms of analysis that you can do to improve upon your predictability. Because ultimately, the people who are going to survive and do well are who have a really good underwriting model. And I think across the board, most of them are trying to figure out a good underwriting model. And I think people are using all kinds of. I think there's no one answer for that.
The only thing to add here is that I agree that more social data and all those approaches don't add too much value. The only area where I've seen some value is more forward-looking risk assessment in terms of trying to predict who is going to be earning X thousand